Hi again, welcome to our accounting classroom. And today the topic that we will be dealing with is dissolutions of partnerships. And we know that persons will come together and they will join together to put their resources and maybe their specialties together so that they can grow a successful business. But at some points in times, during this agreement or partnership, some things may go wrong and then the partnership may have to come to an end, which we call they're dissolving it, or the partnership is then the business. Once it is dissolved, the business has ceased to trade and to operate. And there are various reasons why a business may dissolve or cease to exist as an operating entity. And I will give you at least four of those. One will be disagreement among the partners. Another one may be death, ill health, or old age of a partner. Another one may be poor performance of the business altogether. And finally, the business may have gone bankrupt. So, when the partnership is dissolved, the assets will have to be sold to pay off any obligations or any debts that the business may owe. Maybe to creditors, or maybe they have loans or stuff like that. So they have to take the assets that they have and sell off these assets to pay off these obligations. And this selling of the assets to pay off obligations will be facilitated by using the cash or the bank account. The closure of the business actually is facilitated through using the cash or the bank account, and this will use to facilitate any money that they receive or any payments that they make to help close down the business. Now, there are some accounting procedures when it comes to the dissolutions of a partnership or a business. The first thing is that the assets are released or disposed of at market value, and these assets are disposed of through an account called the realization account, which we will see shortly when we do our example question here. Then secondly, the funds collected from realizing the assets are used to pay the liabilities, which meaning any money that they receive from selling off these assets, they are used to pay the liabilities. And the partners which would have a current account, their current account, if they have a current account, as a matter of fact, the balance on their current account is transferred then to their capital account. So if the balance on their current account is a credit balance, that credit balance will be transferred to the credit side of their capital account, because the credit balance will signal that this is the amount of money that is due to or owed to the particular partner. So then that has to be transferred to the credit side of their capital account, which will show then that this is an obligation that the business has to this partner. And if the partner has a debit balance, which signal that the partner has actually withdrawn more from the partnership than they really should have, and they owe the partnership some kind of money, that amount is transferred to the debit side of their capital account. Now, the partners at the ending, when we have completed our capital account, for the partner, then that capital account is usually closed. And when it is being closed, sometimes the partner is paid money from the partnership, or it may be a situation where the partner has to actually pay the business some form of money. And this is done to help bring the bank or the cash account that the business have to a closure. Now, we have some accounting entries when we are looking at dissolving a partnership. So the first accounting entry that we may look at is one where you have to transfer the book value of all the assets that are to be realized into the realization account. So as our example question that we have here, we have all the assets will be transferred except the cash or the bank account, because for obvious reason, the cash or the bank account is what will be used to facilitate receipts and payments. So like in this particular example question we have here, we have some debtors and we have some stock and investment, plant and machinery, and freehold buildings, which are assets. So these are really our assets that are to be realized, and these assets has to be transferred to the realization account, and we will transfer them by actually debiting the realization account with their book value amount, which is the value that we currently have there, and crediting the asset account with the same amount, which will cause that account to be closed. The next accounting entry that we will have would that any amounts of money that is received from the disposal of an asset. So let's say we sell an asset. Any money that we receive from selling that asset, we will then debit either cash or bank, depending on the account that we have, and credit the realization account for the amount of money that we would have received from selling this asset. Thirdly, any assets that the partners take over, because we may have a situation where a partner may decide that they are going to take over some of the assets, so which meaning that the business does not receive any money at all for these assets that the partner is taking over. So any assets that is being taken over by the partner without payment, then you would have to debit the partner's capital account for that amount of the value of the asset they're taking over, and credit the realization account for that same amount as well. So the third entry, if the partner is taking over an asset, you debit the partner's capital account and you credit the realization account. Number 4 accounting entry that we may have is when you have funds that you collect from your debtors. So any money that the partnership or the business collect from its debtors, those funds will be debited to the capital account, to the bank or the cash account, and credited to the debtors account or accounts receivable. Now, there will come a situation where that the money that you receive from the debtors, you may not receive all the money that was actually owed to you. So in this case, the amount of money owed to the business here, the partnership here, is $2,440. So if the business does not collect that full $2,440, the difference between what they collect and what is left, the difference between what they collect and what was actually owed would be deemed either a bad debt or a discount. So if you deem it as a discount or a bad debt, that figure then is debited to the realization account, and obviously the asset account will be credited for the difference, which will close the asset account. Now, when we now have to look at recording payments of liabilities. So when you are paying the liability account is debited, and the cash or the bank account will be credited for the amount that you pay for the liability. Now, any funds similar to the debtors, any funds that you did not collect, any funds that you did not actually pay for that liability will be deemed as a discount. So the portion that is being deemed as a discount will be credited to the realization account, and the liability account will be debited, completing the double entry and closing off that liability account. Now, when you are closing down a business, you will usually have a cost being incurred for dissolving the business, or what we will call the cost of dissolution. So this cost of dissolution would be debited to the realization account and credited to the bank or the cash account, because obviously this money is being paid for actually dissolving this business. So you may be paying an accounting firm, or you may be paying a lawyer, you may be paying somebody to dissolve this business. So you have to debit the realization account and credit the bank or the cash account for the amount. Now, after you have done all of that, then what will happen is that you will either, with reference to a partnership, you will either realize a loss. They may ever have a loss on realization, or you may have a profit on realization. So if you have a profit on realization, then that profit is debited to the realization account, and the partner's capital account is credited. This here is done in the partner's profit sharing ratio. Okay, so you will use the profit sharing ratio of the partners to record the profit or the loss on realization. So again, once there's a profit, the realization account is debited and the partner's account is credited. If it is a loss, the partner's account is debited and the partner's capital account is debited and the realization account is credited. Now, sometimes we have a situation where we may have what we call an insolvent partner. And an insolvent partner means that this partner is practically bankrupt and the partner cannot pay all of the debt, or cannot pay the debt that he owed the partnership, or he can only pay some of the debt. So there is a ruling that that occurred with reference to a court case and how you deal with insolvency of partners. Now, as I said, when it comes to insolvency of partners, the partners cannot pay all amounts owed to the partnership, and then that they are deemed insolvent if they can't pay all that is owed to the partnership. Now, what happens? The remaining partners then must share the insolvent partner's debt owed to the partnership according to their last agreed capital balances. So it is not they don't share it in the profit sharing ratio. They share it in the ratio of their last agreed capital balances. And this rule came about with a court case between Garner versus Murray in 1904. So this was actually decided in court, and this is what the partners would do when they have an insolvent partner. And you record these amounts, and this helps you to bring the capital account to a closure. So let's look quickly at our example question that we have here. Now we have this question: Saunders, Thomas, and Baker. They are in partnership sharing profits and losses in the ratio of 3 to 2 to 1 respectively. Now, the following is their statement of financial position as at April 1st, 1996. So they have creditors of $3,500. The current accounts for Saunders and Thomas has credit balances of $860 and $520 respectively, and the capital accounts of the three partners, Saunders, Thomas, and Baker, has credit balances of $9,200, $4,600, and $2,300 respectively. Then we have cash of $1,790, debtors of $2,440. We have stock or inventory of $3,000, investments of $3,164, plant and machinery of $5,704, and freehold buildings of $2,932. Now, Baker has a debit balance on his current account of $1,950. This stands to reason that this is the amount that Baker's owe the partnership because he has withdrawn too much. However, Saunders and Thomas has money due to them on their current account. Now the question goes on to say it has been decided that the partnership should be dissolved. Saunders agreed to take over the stock, plant, and machinery and freehold buildings for a total value of $10,200. So he is deciding that collectively he's going to take over stock, plant, and machinery and freehold buildings for $10,200, right? And the investments are sold for $1,720. Creditors are being settled for $3,400. And the debtors are going to realize $2,112. And when we say that the debtors are going to realize this amount, what we are in essence saying is this is the amount that we are going to receive or collect for our debtors. Additionally, Baker is declared insolvent, and a payment of 25% of each dollar value of his debt is being received from his estate. It means that Baker cannot pay all the amount of money that is due to the partnership and that is owed, and he is deemed insolvent, but he's only able to pay 25% of what he actually owes. So what we are required to do, we want to show the transactions that we're looking at here, how they're going to be dealt with in the realization account, the cash and the capital accounts of the partners, and we're going to share this final settlement made by or to the partners in their capital accounts. Okay. Now we just went through the accounting entries. I went through those accounting entries for you. So the first thing that we're going to do is that we're going to do the first accounting entry where we are going to transfer the assets at their book value to the realization account. So we're going to transfer our stock at $3,000, our investments at $31.64, our plant and machinery at $5,704, and our freehold buildings at $2,932. So these are our assets that we have here that we are currently transferring to our realization account at their book value, because the accounting entry tells us to debit the realization account and to credit the asset account. Now we are going to go on. Let's look at the capital account of our partners. So our partners have a balance bottom on their account. Saunders is 9,200, Thomas is 46, and Baker is 23. Now our cash account has a balance bottom on it as well, and that balance is $1,790. And we will see this from our question here. This is the balance on our cash account. These are the balances on our capital account. Now, the second accounting entry that we look at is if we had assets that were disposed of, we would debit the cash account for those assets that were disposed of and credit the realization account for the same amount. So we have our asset that is disposed of here, that their investments are sold for $1,720. So we are going to debit debit our cash account for the $1,720, and we are going to credit our realization account for the same $1,720. So that is the first one. Then we will look at the fact that the question also states that our debtors will realize $2,112. So we are going to debit our realization, our bank account. Sorry, we're going to debit our cash account. I keep saying bank account because it's custom to bank. We're going to debit our cash account for the $2,112, and the credit will go to the debtor's account for that same $2,112. But if we look at this here, we will see that the amount that is owed to the partnership from the debtors is $2,440, and we are only receiving $2,112. So then we are going to look at that this difference is a discount. We can also look at it as a bad debt that we wrote off, but I'm going to look at it as a discount allowed. So that discount then is going to be debited in the realization account, and we will credit the debtors account for the difference in that discount. Okay, so we will debit the realization account, and that difference is 328. For the difference, so that is with the funds that we are collecting from our accounts receivable. So we record the funds that we collected by debiting cash, crediting accounts receivable, and then we looked at debiting the realization account for the difference, which is 328, and the debtors account is credited for that difference as well. The question also said it said Saunders agreeing to take over stock, plant, machinery, and freehold buildings for $10,000. And one of our accounting entries state that if a partner is taking over assets without payment, then the partner's account would be debited for the total amount of the assets he's taken over, and the realization account is credited for that same amount. So realization, and it is Saunders for 10,200. And the realization account is credited for the same 10,200. So we have taken care of the assets at their book value by debiting the realization account for the amount that the assets at their book value. We have taken care of the assets being taken over by Saunders at $10,200. We have looked at the investments that are being sold, so we have debited the cash account and credited the realization account for the investment being sold. We have looked at our debtors, the amount of money we collected from our debtors by debiting the cash account and the debtors account being credited, and then the differences of discount that is debited in the realization account. So now let's look at our creditors. So we are settling our creditors for $3,400, which means this is the amount of money that we're going to pay our creditors. So since we're paying our creditors $3,400, we are going to credit the capital account. We are going to credit the cash account. For this $3,400, and the creditor's account would be debited for this $3,400. Now, if we look at our statement of financial position, we will see that the amount of money that is owed to our creditors is $3,500, and we now only pay them $3,400, which means there's a difference of $100. And we said that any funds not paid to our payables will be deemed a discount, and that portion will be credited to the realization account. So now we are going to credit the realization account, because we are deeming this that this is discount received for the $100. That is the difference between the $3,500 and the $3,400. So now our realization account is completed, and if we look at our debit side of our realization account, if I total this debit side, it is bigger than our credit side, because if I total my credit side, my debit side is $15,128, and my credit side is only $12,020. So basically, there's a difference between my debit and credit side of $3,108. Now, this $3,108 will be shared among the partners in their profit sharing ratio. And we can see here that this is going to be a loss on realization. So this loss on realization will be debited in the partner's capital account and credited to the realization account. So let's look at doing this, inserting this loss on realization. So we have the capital accounts of the partners. So the first one we have is Saunders, and Saunders profit sharing ratio is based on the question. The profit sharing is 3 to 2 to 1. So in a total this is 6. So Saunders is 3, 6. So this is maybe 3 on 6. Thomas is 2, 6, and Baker is 1, 6. So here we have the amounts for the partners. So now our debit and credit side will equal each other. So Saunders capital account will be debited for $1,554. Thomas will be debited for $1,036, and Baker for $518. So let's look at continue to look at our capital account. So looking at our capital account now, remember that our partners had balances on their current accounts, and we have to transfer these balances to their capital account. So Saunders and Thomas balances will be transferred to the credit side of the capital account, whereas Baker's balance will be transferred to the debit side of the capital account. So current account, and this will close their current account. For Baker is $1,950. Current accounts for Saunders is $860, and for Baker $520, for Thomas $520. So we've closed off their current accounts. So now we have to look at totaling our, because all our other things were taken care of, so we recognize that they told us that Baker is insolvent and he cannot pay his full debt that he's owed to the partnership. So which we know we have to apply the Garner and Murray rule. So in order to apply the Garner and Murray rule, we have to total Baker's account to see how much he actually owes the partnership, then to determine how much he can pay, and then how much Thomas and Saunders will have to pay on his behalf. So let's total his account. So Baker has a total on the debit side of $2,468, whereas on the credit side, his total is only $2,300. So this is clearly a difference here. So the difference then, if we look at it between the two figures, is $168. So Baker owes the partnership $168. However, it is stated that he cannot pay this $168. He can only pay 25% of it. So let's see how much he can pay. So it is 168 times 25%, which means he can only pay $42. So the amount that Baker can pay, and he will pay this amount into the bank account. So we will go bank and we'll put the $42. His account is credited for the $42. And the bank account will be debited for the same $42. Now we have to decide how much Saunders and Baker will have to pay on his behalf to help close off his account. So we are told that the amount that they have to pay must be done in their last agreed capital balances. So the capital balance for Saunders is $9,200, and for Baker and for Thomas it is $4,600. So we add those two figures together. So 92 plus 46 is a total of $13,800. So when we're looking at how much Saunders has to pay, because let's see the balance remaining. So it is 168 minus 42. So Thomas and Saunders has to pay this $126 on behalf of Baker. So Saunders will have to pay then where's 92? Right. Saunders will have to pay $84 and Thomas will have to pay $42. So now we have determined the amount that they have to pay. So it is Saunders and Baker and Thomas, will have to pay $126 on Baker's behalf. So then Saunders will pay $84 and Thomas will pay 42. So let's see now how much money that Saunders and Baker will either receive from the partnership or have to pay into the partnership by totaling their capital accounts. So when we look at the debit side and the credit side of Saunders and Baker's capital, Saunders and Thomas capital account, Saunders capital account on the debit side is $11,838, and on the credit side it is only $10,060, whereas Thomas credit side is $5,120 and his debit side is only $1,078. So you'll find the difference between these sides and you will be able to determine. So we can look here and we can see that Thomas is going to receive some money from the partnership, whereas Saunders will have to pay money into the partnership to help close off the cash account. So cash, and we work the difference here, equals so Saunders is going to receive $4,042. So this is debited in his capital account. So it would be credited in the cash account for Thomas. We have to calculate for Saunders. So here, Saunders has to pay the partnership $1,778. This is credited in his capital account. So this will be then debited to the bank account. So let's see if our bank account debit and credit side adds up to the same amount on both sides. It should, to close it off. And here we have it, that our cash account has been closed off because our debit side and our credit side adds up to $7,442. Our realization account is closed and our capital accounts are closed. There are no balances on our capital accounts because our debits and our credit sides add up to the same amount as well. So here we have completed this dissolution question, and we would believe that at the end of the day you would have a greater understanding of dissolutions of partnerships. So we hear the question is again, the example question again, and then here are our realization accounts, our realization account. And we see that there is a loss on realization for the partners. Here is our capital accounts for our partners. And Baker is insolvent. He can only pay $42 into our cash account. whereas Saunders and Thomas have to pay the other $126 for him, and they have to pay that $126 in their last agreed capital balances. So Saunders has to pay $84 on his behalf, where Thomas has to pay $42 on his behalf. And then we have determined that Saunders now has to also pay into the cash account of the business $1,778, which will help close that cash account, whereas Thomas will receive $4,042, which would bring that account to a close. So this is the end of our accounting class for today, and we would connect next time. Like the video and encourage other persons to watch and to like this video on Dissolutions of Partnerships.